there are always two ways to value the market. If you can't look at earnings, then you've got to look at price to book, because there's literally no earnings for 2015. And like I said, at 1,005, you're the third lowest in history. And you can ignore the worst because there's no capital control. Capital control was the worst price to book. So we're almost at the global financial crisis low when it was at 1,005. Assuming that analysts are correct as far as the earnings are concerned, and consensus is 10% next year and minimal growth this year, and you think that all noises have been removed, and I'm making a huge assumption when I said all noises have been removed, then market should go back to mean valuation or neutral valuation. So assuming that all noises are removed, it goes back to mean, assuming 10% earnings growth where everybody is saying will happen next year, which for the last 3 years has disappointed and everybody downgraded to almost zero, then your target should be 1,700, 1,720 thereabouts. But there are a lot of ifs there, you see. So at 1630, is it, or 1640 today, what's your upside? Your upside is almost same as your downside. So if you're a fund manager and your upside risk and your downside risks are exactly neutralized, would you jump in, or would you be a little bit more careful? So I'm putting my lecturing hat here to explain it in a very diplomatic and political way, so to speak. Okay, nobody knows that.
Excuse me. Sorry, when you mentioned that the market could grow up to 1,700 or 1,720, is that by end of this year or after when all the 1 MB issues are resolved and all that?
That's what I mentioned just now. There are a lot of noises. Okay, for the noises, for the market to go back to mean, it's about 14.6, 14.7. For the market to take you back to mean, that means they will lower your risk premium to the country, right? For them to lower the risk premium to the country, noises must have been removed. I have no clue when the noises will be removed. All right. But what I'm saying is that what is your downside on the price to book? And what is your upside based on once all the noises are removed? It's almost balanced, you see. So you asked me, is it this year target or next year target? I said that this is premised on 10% earnings growth next year and noises being removed.